Imagine a world-class marathon runner, known for their speed, who tells the press before a major race that their only goal is to, well, finish the first mile. You'd be suspicious, right? You'd know their real potential is much, much higher. That's the exact situation we're looking at with SoFi's upcoming Q2 earnings report. So in this video, we're going to dissect why their official guidance looks so deliberately cautious, and what the data suggests could actually happen. And if you're just passing through, here's the core of it. SoFi is guiding for 3 to 5% growth, but their historical average is more than double that. When you add record member growth and new regulatory tailwinds that directly benefit their main business, you get a recipe for a significant surprise that the market may not be pricing in. The real question is, what's driving this potential? So, hello, my name is DataCat. This is one of my first videos, so I suppose I should introduce myself. For a long time, I was an analyst, a corporate drone you could say, tucked away inside a Fortune 50 company. My life was a cycle of data models, endless PowerPoint decks, and trying to explain complex trends to executives who, well, let's just say their attention spans weren't always feline-like. I traded that life for this: a keyboard, a camera, and a much better office mate who mostly just sleeps. My goal for this channel is simple: to cut through the noise, look at the numbers behind the headlines, and share what the data is actually telling us. So let's look at the data for SoFi. First, let's talk about that guidance trap. Management guided for Q2 revenue between $785 and $805 million. Now, to hit the middle of that range, around $795 million, SoFi only needs to grow its revenue by about 3% from what they did in Q1. To beat the high end of their own forecast, they need just over 5% growth. On the surface, that sounds reasonable, but here's the context that matters. Historically, SoFi's median quarterly revenue growth is 8.3%. The mean is 11%. It's like a world-class sprinter telling the press they're hoping to just finish the 100-meter dash. It seems overly cautious. This isn't just a feeling. It's backed by their user numbers. They just surpassed 10.1 million members. That's not a vanity metric, it's a leading indicator. Every new member is a potential customer for a loan, a bank account, or an investment product down the line. Now, this growth isn't happening in a bubble. And this is a point that I think is being seriously underestimated. A recent policy change, the Big Beautiful Bill Act, is directly fueling SoFi's most important business: lending. In simple terms, this act has lowered the cap on federal student loans. What does that mean for you as an investor? It means that a whole demographic of high credit quality borrowers, think graduate students, medical students, the exact people SoFi wants as customers, now have to turn to private lenders to fund their education. This isn't a temporary bump. It's a long-term structural shift in the market that funnels high-value customers directly to SoFi's doorstep. It provides a strong, predictable foundation for their revenue, making that conservative guidance look even more achievable. But the student loan business, while critical, is only one part of the story. There's a much larger, more inefficient market that SoFi is preparing to enter, and it's a classic disruption play. I'm talking about the $700 billion global remittance market. For anyone unfamiliar, remittances are simply when people working abroad send money back home to their families. It's a massive market, but it's plagued by high fees. The average is around 6%, and slow processing times. Imagine sending $1,000 to your family, and $60 just disappears into the system, and it might take days to even arrive. This is where SoFi's tech advantage comes in. Recent regulatory clarification has given them the green light to use blockchain and stablecoins for payments. A stablecoin is just a digital token pegged to a real-world currency like the US dollar. It allows you to send value across the globe almost instantly for a fraction of the cost of the old system. It's like replacing a tired old carrier pigeon with a laser-guided drone. One is slow, unreliable, and eats a lot of your seed money. The other gets the job done with ruthless efficiency. For SoFi's tech-savvy user base, a cheap instant international transfer service is an incredibly sticky product. It's a huge new potential revenue stream, and it deepens the relationship with their customers. This all feeds into what's called the flywheel effect. It's a concept that gets thrown around a lot, but at SoFi you can actually see it working. Record member growth feeds the ecosystem. More members use more products, like banking and lending. This lowers the cost to acquire new customers and increases the lifetime value of each one. As the flywheel spins faster, it allows them to build transformative new services, like the remittance platform, which in turn attracts even more members. It's a self-reinforcing loop of growth. Finally, let's touch on the part of the business that the market seems most skeptical about right now: the technology platform. This includes Galileo and Technisys. Revenue growth here was a bit slow in Q1, and management has guided that major new client revenue won't really kick in until 2026. This has set a very low bar for expectations. But this is what makes it a potential coiled spring. CEO Anthony Noto has been very clear that their relaunch of crypto services was just day one of what they can do with blockchain for payments and lending. These are the core functions of the technology platform. So the key thing to watch for in the Q2 earnings call is any hint, any data point that suggests the integration of these new digital currency services is accelerating the platform's growth ahead of that 2026 schedule. If that happens, it would completely challenge the current narrative. It would transform a perceived area of weakness into an unexpected, high-impact accelerator for the entire company. So, to wrap it all up, you have guidance that appears deliberately conservative. You have a powerful regulatory tailwind fueling the core lending business. You have a strategic entry into the massive inefficient remittance market, and you have a technology platform that, despite low expectations, could become a major growth catalyst sooner than anyone thinks. The bullish case here isn't about a single good quarter. It's about the convergence of all these factors, creating a compounding growth engine that the market seems to be misreading. I'm DataCat. I'll be here, sifting through the numbers, trying to find the signal in the noise. If you found this breakdown useful, smash the subscribe and like button for more, and let me know what you think in the comments. Did I miss a key variable? Or am I just a guy who spends too much time with spreadsheets? Alright, that's all for now. I need to go. Analyze my cat's napping patterns. It's a crucial leading indicator for his evening mealtime demand.